What is going on, everybody? It's Eric here, Traveling Trading, and welcome to the channel. Thanks for checking out this video. Now, at the much requested need, everyone, we are about to go through the #1 ultimate technical analysis course for beginners and walkthrough, made simple. All right, so this is going to be a pretty hefty video, okay? Um, so definitely get ready to learn a lot. For those of you who don't know what technical analysis is a little confused about it, this is, the perfect place to get started with learning this, okay? So I'm going to walk you through all this details about technical analysis so that you have a better understanding and grasp of it. Um, a little bit about me, what makes me qualified to talk about this. Again, I am a avid day trader. Been doing this for years. Been in the market for over a decade. So you're definitely, talking to somebody who has experience, who had a lot of failures and a lot of success, but mostly failures, which led to the success. So um, I'm going to go through technical analysis for you guys, and you don't have to worry about paying anybody to learn all this stuff. Okay. Now, after kind of scouring the world of the internet and looking at, what other people are talking about technical analysis is and consistent of, and what their viewpoints are on it and what they try to teach, and even what people that have paid courses try to teach. All that stuff is going to be in this video here, bundled up for you, um, to pretty much watch at your disposal for free. And in addition to that, we're going to do some walkthroughs with it. A lot of them don't do that, so we're going to do that as well too. And most importantly, other than that, is the fact that you're getting for free, is that you're going to have a lot of information that you think might be gatekept, or, only accessible through, some type of paywall right here, right in front of you. Okay. So let's go ahead and kind of get into it before we get started. Of course, this isn't financial advice. This is for entertainment, educational purposes only. Um, Guys, it took me, a couple of weeks to kind of put this stuff together here. So if you could do me a favor and just hit that like button, subscribe to the channel, comment below as well too if you liked it, if you don't like it, if you have any questions, or even share this with a person who you think might be, interested in the stock market or technical analysis. Just here to try to help as many people as I can understand this stuff as simply as possible, because even at the videos I was looking at online for people, and how they're teaching and stuff like that, it could get very confusing for someone who has no idea of what technical analysis is, or even where to begin with it. So this video will hopefully get you in the right spot in chronological order so you can understand technical analysis at the most fundamental level. All right, so let's go ahead and get into it. We're going to be taking some breaks throughout this video as well too, so that you can kind of let the information soak in. It is a lot. And if you guys have any recommendations of any other subjects you want me to cover in the financial markets, I will for you. Again, I have a very extensive, knowledge and years of experience in various different subjects of it. So I'll be happy to do it when I have time. All right, so let's go ahead and get this bad boy underway. What is our objective today? So today, guys, I want you to learn technical analysis, okay? I want you to know when you can use technical analysis. I also want you to learn how to perform technical analysis. And I want you to be able to pretty much look at a chart, or almost any chart, um, in any financial market that you're, familiar with, and understand what you're seeing. That's kind of the main thing there. I want you to be able to pull up a chart or look at somebody else's stuff, say, oh, okay, I can see this, I see this, and I see this. I want you to develop that vision based on, branching out your knowledge of what you're going to learn here today. And ultimately, I want you to learn how to profit from technical analysis, because that's what it's all about. I definitely want you guys to make money, whenever you can, as much as you can, as often as you can. So that's what, I hope for you guys to learn here today. And I want this to be like a one-stop shop for beginners. You don't need to be scrolling around every other video on YouTube just to try to find everything you're going to learn here, um, you know, and spend hours just searching and searching. So we want to make that as easy. So I'm going to cover everything, and what we're going to do, on the topics that we cover, we're going to pretty much start from a broad perspective and then we're going to be zooming down to the finite perspective of technical analysis. So basically from big to little, so that you can, again, see it in chronological order, see how things break down, and make it make sense for you. Okay? So first off, Eric, what the heck is technical analysis? Well, to be, you know, direct, technical analysis is a form of an investment valuation that analyzes price past price points to predict the future. And basically, it's technical analysis is like an attempt to understand market sentiment behind price, trends and patterns and things like that. So basically, what you're doing with technical analysis is you're looking at what happened in the past to hopefully predict what's going to happen in the future with an underlying security, whether it be stocks or um, price valuation, whatever the security might be. Um, some things to know about technical analysis, unlike fundamental analysis, is that it's solely based on price, not the actual fundamentals of a company. So you can probably care less about, you know, the PE ratio. You can care less about the sales revenue, the quarter growth. You don't care about any of that with technical analysis. What you're looking at is price action in the actual security that you're looking at, okay? Um, so understand it's all based on price. Also with technical analysis, just understand, when you're using it and stuff like that, you don't need too many tools because if you have too many tools and indicators, it's going to give you conflicting signals, okay? So we're going to break that down in a little bit more detail as well too, but understand that too many, tools and calculations can, conflict with each other. Um, it's kind of like having, too many tools in your toolbox. You need to know when to use the hammer and know when to use, some pliers or a screwdriver or a wrench or whatever you might need to use. Okay. So time and place for every tool. You don't need to use them all at once. uh, Sometimes Swiss Army knives are good, but yeah, not all the time. And basically, we're gonna, understand, what financial markets um, use this technology as far as technical analysis. And what it comes down to it, because I know a lot of people are confused about this. Some of you may trade stocks, some of you may trade forex, some of you may trade derivatives, or any other type of financial tool. Sorry if I'm gazing off. I'm looking at a trade that I'm in. But as far as what financial market you need to apply this technical analysis to, is really all of them. Due to the fact that you're analyzing price, all the markets have some type of price evaluation that's associated with them, and technical analysis uses the foundation of price action to be correlated with the market psychology on any kind of particular given, point in time and future. Okay. Um, and there's some people that say, technical analysis is a bunch of BS, and some who don't, some who, use it all the time. And although both of them can, be true or not true, um, kind of keep in mind that if so many people follow something, it could almost become a self-fulfilling prophecy. Because if we're all seeing like the same stop sign, we're all going to stop, kind of thing. You know what I mean? So just kind of understand that. As some people who might say, "Oh, stop sign isn't real." So it's just a matter of perspective. But technical analysis um, is for those who use it and those who don't, because of the fact that the markets are so random. You know, some people might say this is a bunch of goobity god, whatever you want to call it. But yeah, so that's pretty much what technical analysis is. Okay. All right. Now, how do you perform technical analysis? It's pretty simple. Well, not pretty simple, but it can be. Excuse me. So understand that technical analysis again is going to be analyzing the movement of price through the form of either charting or chart analysis, and just kind of recognizing patterns and trends and other things on that chart that you're looking at. So there's these things called indicators that help you determine the price movement through different price changes, real time. Um, and then there's also things like order flow and price level action and level two. If you don't know what I'm talking about, don't worry about it. You'll get it in a second. But There's also things like that that help you that help you perform technical analysis. It's just to analyze any kind of stock or security or currency or whatever you're looking at to trade. It's kind of the most broad way to view the process of technical analysis. That no matter what discuss throughout the video, no matter what we discuss throughout the video, or what you might see online in books, is going to typically fall under one of those three categories when you're performing technical analysis. Okay, you're either going to be looking at a chart and analyzing it. You're going to be looking at indicators on the chart and analyzing it, or you're going to be looking at price action and order flow. All that stuff falls under technical analysis. So I just want you to understand that, and that's how you perform it. You're going to either analyze a chart, you're either going to look at a bunch of indicators, or you're going to analyze order flow. That's, you know, technical analysis, right? Pretty simple. Alrighty. So let's talk about charting. So basically charting and charting analysis, there's, a few basic different layouts of charts. And as a matter of fact, I might be able to pull some up here for you so you can kind of take a look at it. We'll do it in a second. There's different types of charts. There's heat maps, um, there's index charts, there's net flow charts, advancers and decliners, there's global scatter plots, and there's plenty more. I mean, there's tons and tons, guys, of charts that you can analyze. We're only going to focus on one because really it's just the main one that everyone uses. Um, and these are just kind of viewpoints of different graphs and charts that are available to kind of look at, just kind of showing you those. But we're going to focus on one particular chart, okay, as we go through this. So some of the main points when it comes to like trading stocks, and I kind of want to focus just on trading stocks, but again, this applies to Forex and, you know, um, derivatives and other stuff that you might trade. Um, some of the four main charts that we're going to look at are bar charts, point and figure charts, line charts, and candlestick charting. Particularly, we're going to focus on candlestick charting because that's what mostly, traders use. And of course, we're focusing on trading and day trading. So that's what we're going to focus on. Bar charts are okay. Plot and figures I don't really like. Line charts are like very undetailed. So the reason why candlestick charts are very important in technical analysis, especially for traders, because of the amount of information it contains when you're just looking at it. Um, and again, it's kind of like the more information you have, the better you can make educated estimates on what you might predict the price action to do next. I know some videos they go over like the history of Japanese candlesticks and stuff like that. I'm not going to go over all that. It's not relevant to learning. It is relevant, but you can do that kind of on your own time. This video will probably be long if we were to do that. But you can look at the history of candlesticks later on in your own time. It's really good information to know. Um, but we're not going to do that here. All right, and so what we're going to focus on in the chart of candlesticks by doing this technical analysis are the proper ways to read the candlesticks, okay? So when you're looking at candlesticks and technical analysis of a chart pattern, those patterns will typically form from the candlesticks, as you can see in this chart here that we have. So we're going to break down what the candlesticks are telling you. We're going to break down the type of trends and patterns you might see, and we'll just go over probably a few examples in TradingView so you can kind of get an idea of what we're looking at. And we'll also, just kind of analyze it a little bit more so you can understand the psychology behind the candlesticks and the way it makes, traders feel or interpret the market in different ways, okay? So you can get a better understanding of that. So if you take a look here, these are examples of the candlesticks. They'll either be green or red, depending on, your charting platform that you're viewing charts of the security you're looking at to do the trade, to do the technical analysis. But basically, this is what the candlesticks tell you. This side right here shows you that it shows you what it opened at. This right here shows you what it closed at. This wick right here, this line right here is called the wick, shows you how low it went during that time frame, and this wick right here shows you how high it went during that time frame. Okay. Now, whether it's white or green or black and red will let you know if it's a bullish candlestick, meaning that it's going up, or a bearish candlestick, meaning that it's going down. So for example, here on this right here, the bullish candlesticks, you can see that this one is going up and this one on the bearish side is going down. So kind of the best way to interpret this is that when you see, you know, a bullish candlestick, know that it opened here at the bottom and then it closed to the top. When you see the bearish candlestick, you know that it opened here or it opened here and then it closed down here for the price action. So that can, be interpreted a few different ways, and we'll actually pull up an example here on TradingView so you can kind of get a glimpse of what I'm talking about. Now, within these candlesticks, as this is loading up here, um, you'll be able to see that as they are forming, they are going to do different patterns. Like for example, not all candlesticks will look like this. Sometimes they'll look like this one right here and have a hammer, where you have the open and close be very small, but a long, long movement of price action on the wick right here. You'll have you have patterns like the hanging man. You'll have a bullish engulfing pattern. There's so many different patterns that you can kind of look at and study that you would probably want to familiarize yourself with when it comes to doing technical analysis. For whatever reason, you might be performing technical analysis. Let's take a look at, I'll pull up a stock here in a second. We'll pull up like Snapchat or something so you guys can look at that. Forgive the noise in the background if you hear that. But yeah, so these candlesticks will tell you a lot. So they don't always look like these full bars here. Sometimes they'll be tiny bars like that with a long wick. And all these have like different types of names. And then within those candlesticks, multiple versions of those candlesticks will form some type of pattern. And from those type of patterns formed by the candlesticks, you'll get either some type of trend. Um, so you'll kind of get all that as we kind of go along. Like for example, let me pull this up here. You'll see right now just kind of analyzing like Snapchat, like at this point in time, this was a bearish candle. So that means it opened up here at $36.01 and it closed at $35.81. But within that time frame, sorry, within that time frame, it went all the way up to $36.17 and then all the way down to $35.76. And it's like that so on and so on throughout these, candlesticks. Okay. Pretty easy to kind of understand there. Hopefully that makes sense to you. So, but again, you know, just kind of knowing these different patterns helps you out quite a bit. Now, once you have a multiple set of candlesticks within a certain time frame, eventually what they can do is form a trend. Like this graph right here, example for Zillow, shows you an upwards trend being formed, okay? Because the candlesticks have been moving the price up from open to close at this point in time, from open to close at this point in time, et cetera, et cetera, et cetera. All right. And that would give people the indication that, hey, Zillow is in, a great standing because it's trending upwards, which means the company is perceived as being more valuable. Okay. Obviously, if it's bearish, it's going to be seen to be overvalued and need to be coming down. All right. So pretty simple there. And again, this might seem like a lot, but we'll go into this stuff a little bit more detail so that you can understand it more fully. Okay. All right. Now, within those candlesticks and those trends forming, this can cause a security or whatever you're trading to be what's called volatile. Okay. So, what is volatility? What is a volatile stock versus a non-volatile stock? You would want to know that in your technical analysis. So, volatility is basically the movement of price over time. And the more volatile a stock is, the more it will be fluctuating in price. The less volatile the stock is, the less likely the less likely the price is going to move with big movements in the price action. Okay, how does this happen? It could be a number of different things. Volatility happens when there's a new catalyst coming out for a product or security. It could be you know some approval for a company to pass some type of FDA regulation. It could be rumors of, something happening within a company or global economic forces causing like the dollar to fall or something else to arise. It could be a number of different things that might cause volatility from any type of security. You kind of get the gist there. Um, which is why a lot of traders, might listen to the news and look at, you know, press releases and things like that because these catalysts can cause a stock to become very, very volatile. All right. And this is, sorry, and this is where a lot of times you'll see, like limit orders you might place not getting filled. If you wanted to buy a stock at, 35 bucks and you put your order in and the price has been at like 35 bucks for a while, but your order still hasn't gotten filled is because there's no volatility there. There's no buyers and sellers who want to exchange enough of the shares at that price in order to fill that order. But once it becomes volatile, then, you know, it's going to be filled because more people are going to be coming to it. So let's kind of go over the different types of volatility. Okay. So there's high volatile stocks, which have high volume and high price fluctuation, which means there's a lot of people trading this in high volume, and the price movement is moving all up and down on the chart. It's getting crazy. As you can see here in this graph here, this is a highly volatile stock. It's going from $10 to $100 all within a short time frame. That's high volatility. Then you have stocks with kind of medium volatility, where there's high volume. There's a lot of people coming in to trade the stock, but the price isn't fluctuating that much. You could have like a billion shares trade, but the stock only moves $1 or $2. Depending on your definition of volatility and how the stocks perform, that might be a medium volatile stock, which means a lot of people are trading it. They just don't think the price should be, you know, fluctuating that much. So then there's low volume with high price fluctuation, where you might see a stock just jump right up, but it is barely moving. That's like a light volatile stock. There's not many people trading it, but the price just went up for some reason. Um, that happens sometimes as well too. Then there's low volume and low price fluctuation, where there's barely anybody trading it and barely any type of price movement happening with it. Um, that's a low volatility stock. Me personally, as a trader, I prefer high volatility stocks just because it gives me more opportunity. So, and you can kind of see this is a low volatile stock. Not much price movement is happening um, with it, so it's not very volatile. As time goes on, it's not really moving much in terms of dollars. Okay, the price isn't jumping all over the place. You could have like a bunch of people trading it at that point, but the price isn't fluctuating that much, so it's not very, very volatile. Okay. Um, Typically, when a stock might have, this is a good note for a lot of people who are traders and want to know this, but a lot of times when a stock has low volatility, some companies, depending on the companies, will put out like fake news and press articles to get the stock to become volatile because more people are going to look at it and try to jump on it based on that news. Okay. So you'll see a lot of fake news out there, or different catalysts that might cause the stock to move when you can tell like a couple of days ago the stock wasn't doing nothing. As a matter of fact, let me see if I can find you an example here, and we might be able to take a look at one of them right now. Like this stock right here, I just pulled up ANGH here for you guys. So you can see here, this stock isn't very volatile, and the price price is kind of fluctuating a little bit from $12 it went all the way up to $18. So that's a decent amount of price movement. But there's no volume there. There's no, you know, not many very heavy bars as opposed to what we just looked at with Snap. Snap has been very active today, but it's also a larger cap stock. You see these bars are much more full. There's much more traders deciding on the price of this. This thing has, been running today because they had earnings coming out, which was their catalyst, and that caused them to, have a lot of traders look at them after they, reported a strong earnings. They reported their first profits. So many people came in the next day right here looking at this saying, oh, okay, this might be worth investing, or some people might be saying, oh, it's not worth investing. Either way it goes, those traders all came to the fore because of that catalyst. And now you're looking at the candlesticks and you see that this thing has become, more volatile because there's a lot of traders looking at it, more volume. Okay, so that's what technical analysis in terms of looking at volatility means. Some traders, most traders, I don't see why none wouldn't, wants a volatile stock. Investors don't really like and don't really like volatility. They want to know, they want to be able to see that the stock is going to continue to trend. So depending on your trading style or investing style, you might be an investor who wants to see a strong, trend of low volatility, so the stock could keep going up and up and up. Or you might be a day trader where you want to see a lot of volatility and a lot of price action movement, so you can have opportunities to profit on, different points in time of the underlying security you're looking at. All right, cool. Now let's talk about market structure and stock structure, market and stock structure. Okay. So within those candlesticks that you see and analyze and learn about, and the trends that begin to form from those candlesticks and that price action movement and that volatility, what happens is it creates what's called market structure, which shows you the direction of the stock. Like I told you that it could be either trending up or trending down. That is what you're looking at when you're doing technical analysis. So kind of like how this says here, all the information you really need to kind of determine market structure is price, and only the price and the market structure comes before the indicators. Okay. um, what matters is to spot the highs and the low points, and we're going to go into that a little bit more detail, because the high points and the low points help you determine if the market structure or direction is bullish or bearish. Okay. So as in this little, you know, example here, excuse me, this would be considered bearish because it's downtrending from the price action. So usually what happens with that too, the market structure will tell you what you should be doing, whether you should be buying, selling, or staying out. Okay. Um, and this is again also determined by the candlesticks and the moving averages, which we'll get into in a second. And collectively, the movement though and the price should help, will help make up the market structure, and that's why you'll see analysts and traders talk about the market either being up or being down. Today it helps you be able to, judge the sentiment of the market when performing your technical analysis. Okay, so let's kind of take a look at actually, individual stock, do a little technical analysis there. We'll look at Snap here again in a second. And when, traders typically look at the stocks, they look for levels of support and resistance. And we're going to cover that here in a second. And that gives them the ability to find, key areas to be able to find patterns. All right. Um, so let's kind of take a look here. And again, guys, as we go through all this, it'll be, more and more understanding. All right. So let's take a look here at Snap. You'll want to look for high points and low points throughout this stock here to be able to find the market structure of, you know, this underlying security, Snapchat. Or if you want to do like the overall market, which some people might use things like SPY or the ETF to kind of gauge that, you can pretty much look at the high points and the low points here and be able to determine that. And again, once we kind of cover some more stuff, I'll do it all for you here in the big picture, and you'll know how to do full technical analysis, okay? But that's what market structure is. It just shows you the direction of the stock based on the price movement of the underlying security or whatever it is you're looking at. Now, when that market structure is forming, guys, what did I say they look for? Within those, within that market structure formed by those candlesticks that are price action of the security going up and down, what do they look for? They look for support and resistance. Okay. When they look for support and resistance, what they're doing, what technical analysis, what you're doing there is you're finding, different trends based on that support and resistance. And we'll go over those trend patterns here in a second. Okay. Um, but this right here, you can see in these, little examples here, you're going to get different examples of support and resistance. You'll have, where it's trending sideways. You'll have where it's trending up. You'll have where it's trending down, and you'll pretty much have where it's different levels. Okay. Um, so what are they doing here? Again, looking for key levels of buyers and sellers who, made it to help determine, how they feel about the security at a particular price point. And how long do you look at the time frame for? Because a lot of people ask that. Do I look at it on the minute time frame? Let's take a look. Like for example, with Snap, they'll say, how do I determine, that? Do I have to look at the 1 minute time frame? Do I look at the 5 minute time frame? Do I look at the 20? It doesn't really matter. It just depends on you as a trader or investor. Obviously, with technical analysis is usually, you know, day traders or swing traders uh, performing technical analysis. So yours, it could be anywhere from 30 seconds all the way up to weeks, depending on how you trade. So again, there's no right or wrong answer to the time frame you choose. Just choose whichever one makes you comfortable, and that takes a little bit of you know practicing for some people. So understand that. So there's no particular time frame you got to worry about. But when determining support or resistance, what is it you're looking for? What do you look what key levels are you looking at? You're looking at the highs of the days, the lows of the days. You're looking at pre-market highs, pre-market lows, and you want to know also too the all-time highs and the all-time lows because these are key levels of support and resistance, okay? Um, and with those levels, they'll help you to perform technical analysis to determine, how you're going to be able to profit for the stock, which of course is the ultimate goal. Okay. And again, that all makes sense as we're going through it, and we'll do a full walkthrough, and you guys will be able to understand, all that. Okay. So let's kind of do an example real quick here of plotting support and resistance, and I'll be able to kind of show you guys what I'm talking about. Again, we'll keep, Snapchat up here, and let's do it on the minute time frame. I'm sorry, I'm a little biased to the minute time frame because that's what I trade on. But it doesn't hurt to know a little bit more. So you see how here they drew these lines of support and resistance from the high points to the low points throughout that time frame. That's what you do when you're doing technical analysis. So let's do that here with Snap. What we're going to do is going to look at the stock for today. Well, actually, let's do it from yesterday as well too. Now we do it from today. You might want to keep this in mind of what yesterday was, just in general for general purposes, but we're not going to draw anything like that. We're going to start from today pre-market. And of course, I'm doing this video recording right now, so it's, obviously taking up, it hasn't done the whole day, so that's no problem. That's why I love you guys. I'm trading throughout the day. I should be trading. All right. But look, let's take a look here. Now, what did I say we're going to look for? You might want to write this down, but you'll eventually get in the habit of doing this. You want to remember the all-time highs, all-time lows, the high of the day, and the low of the day, pre-market highs, pre-market lows, and previous days and highs and lows. Okay. So let's go ahead and begin. Let's start here from the pre-market time frame. We're going to click on this little line here. Now, whatever broker you use or trading platform that you use to, look at charts and analyze and do your technical analysis, it'll have tools like this that you can, do that with. I'm using TradingView, one of my favorite charting platforms, but you can also use things like Thinkorswim or Webull, all the other ones that I tell you guys, are good. There's no right or wrong, one to look. As long as you can, use the interface to your best, ability, that's what mainly matters. All right, so let's take a look here. So you got Snapchat opening up here, and pretty much you got it from right here to right here when it comes to the pre-market time frame. That's the high points, and here are the low points. Okay, that's pre-market. Now, if you want to plot the previous day highs, this of course would have been from after the news catalyst because this thing was, dead, kind of trading sideways really. The high point was right here. Previous day's highs, and that includes after hours too, guys. Me personally, some day traders might not consider after hours of the previous day to be worth it. I do because that's going to help with trading throughout the next day. Okay. So that's the high point, and of course, this was the low point, $23. If I was in this trade and that thing started to go to $23, I'd get scared. But anyways, so we got that there, and then let's take a look at the opening bell time frame. Boom. This is good. Okay. All right. So I know you're probably looking at this and wondering what the heck is going on. What is this? I have no idea what I'm looking at. Don't worry. It'll all make sense here in a second. But this is pretty much how you plot levels of support and resistance. You got levels of support right here, levels of resistance right here, and right here. As a trader, those are key areas for you. Like I said, we don't really need to look at the 52-week high, 52-week low. I mean, unless you want to, you can. Mainly, I like to focus on previous days of highs and lows, because those are key areas when the price action of those candlesticks goes between those goes beyond those points. Then we're starting to see something great. Okay, and we'll cover that a little bit more. But this is pretty much how you kind of plot support and resistance. And you can do this with any type of security or any thing that you're trading. This is kind of one of the bases of technical analysis. Okay, because a trader might look at this and say, oh, okay, I see that there's a lot of people who buy at this point and at this point and at this point and at this point. This thing is obviously trending up at this point. You know, so and this is just for the day. I'm not going to break down like the different traders and stuff like that in the time frame. That's stuff you just learn. But you know, this is just you know performing technical analysis. So let's try to stick with that. All right. So that's pretty much how you plot support and resistance. Pretty easy, guys. Finding high points, finding low points, drawing the straight lines between them until they're done, and we'll see what happens here. All right. So let's close that out here. Get that out the way. All right. Let's kind of recap. Let's take a break because this is a lot of information in a little bit of time. So what did we just do? What did we just learn? We learned what technical analysis is. We learned that technical analysis is having the ability to analyze it, to have a chart to analyze the movement of price action of an underlying security at different points of time to be able to help make an educated guess of where the stock might actually, end up being at another particular point in time in the future. So basically, you're looking at a chart, analyzing the chart, and deciding what might happen to the stock or security. Pretty easy. We learn what volatility is. We learned that volatility is the movement of price over, certain periods of time, whatever time frame you choose. And we learned that having high volume and a lot of price action causes high volatility. We learned that having a little bit of people trade at low volume and low price movement gives you low volatility. So we learned that. We want to find volatile stocks. Then we learned what market structure is as well too. We learned that within those candlesticks and how they work, that they eventually form a pattern to let you know if markets are trending upwards, downwards, and how you would feel about the underlying security you're looking at. And then we learned how to plot support and resistance by finding higher highs, higher lows. Okay, so take a quick break, let all that sink in, revisit some of the slides if you need to, and let it all soak in because we're going to pretty much just build up from here. We know now the basis of technical analysis of analyzing a stock, a security, a commodity, whatever it is, because we know that we're looking at price and what the price does over the past to predict the future. All right, so hang in there. We're just getting started. Let's get to it. All right, guys, so we are back at it again here. Let's go on to the next segment here of this technical analysis for beginners. All right, so again, we know, what technical analysis is. We know volatility, what we look for. We know what market structure is, and we know what support and resistance is and how to find it. So let's kind of move on to the next part of technical analysis and what you need to do to perform it. All right, so when you're performing technical analysis, what typically happens is that when you draw your lines of support and resistance and stuff like that, it's going to be able to show you some type of chart patterns. And this is what a lot of traders look for, okay? Now, there's tons of different patterns out there. What I usually tell traders who are beginners, try to just pick one pattern and stick to it. It's good to know all the patterns if you can, but you don't need to know every single pattern. Um, I mean, it would literally take you a lifetime to probably like master just looking at them. If you can do it, that's great. I suck at looking at patterns. Some people can look up in the stars and see patterns. I can't do that. It took me years to just to master like three or four of them. But you don't starting out as a beginner trader, you don't need to learn every single one. It's good to get a good fresher on them. But kind of sticking with one and focusing on one will help you develop as you get more experience with doing like technical analysis and things like that. So chart patterns themselves, let's kind of talk about them. They can be typically broken down into three categories. They're either going to be bullish or bear. Well, actually two categories: bullish or bearish. And within those two categories, usually they're going to have either signs of continuation or signs of reversals. Okay. So those are typically the things that you're looking for as a trader when doing technical analysis. That way you can begin to plan your trade. All right. And what we're going to do, just kind of look at some of these. There's several different patterns to choose from in different categories, and we'll touch on them. We're only going to touch on just like one to maybe three of them, just a few. So for time purposes of this video, I don't want it to be too long for you guys. Any other patterns you want to explore, I'll be doing, separate videos on that. You can check those out later or look them up, from other places at your own convenience. We're not going to do too many here in this video, but I'm just want to show you guys how to plot them and how to see them so you can understand that, because a lot of these, other videos, stuff like that, don't really show you from start to finish how to do it. And the ones that do show it to you are leaving out other technicals that you want to look at as well too to be able to determine that. And we'll cover all that here as we go along. But again, like I said, I'll have a whole nother video that just covers certain patterns, or one video for bearish double top, one for head and shoulders, and all that stuff that you guys can look at on your own time on the channel later on. Okay, so here's just some of them. Like, let's look at the reversal patterns. There's like bearish double top, bearish head and shoulders, bearish rising wedge, bearish expanding triangle, bearish triple top. You know what? I'm not going to read all these. You can read all these on your own. You can pause this video and write those down if you want. There's plenty more than that, but these are some of the most common ones that people, look at and see as traders and begin to strategically form their trading strategy based on what they're seeing there. Okay, so we're going to dive into some here. Let's take a look at the ascending triangles, one of the most popular ones that people look at. So with an ascending triangle, what you have there is, first you have to have an uptrend. Okay, the stock spiked up for some reason, whatever, and it's in an uptrend. And then second, you'll see the consolidation of it pulling back. Okay, once it pulls back, you'll start to see, you know, rising, what's called rising lower trend. So you'll see higher lows, higher lows, higher lows coming up here. The fourth thing you want to look for is, a flat, upper trend line. Where is the stock, being stopped at? Okay. And then you're going to see it start to consolidate, there. This is one of my favorite, patterns to play. I've done a few other videos on this, recapping some other trades where you'll see this exact pattern here. And then all of a sudden what happens here, boom, a breakout and the trend continuation. As a matter of fact, we can do one right now here based on the stock we were looking at, Snapchat. The reason why I'm picking on Snapchat, guys, actually is because if you look here in the group chat and everything like that, we actually had it on the watch list. Let me see if I can pull it up here. We had that on the watch list along with any. Um, just kind of looking at that stock to trade. So that's kind of why I'm picking on it. And the reason why I was on the watch list for today is because yesterday, last night, as you've seen in the chart, it had, strong earnings, just reported, quarterly profit for the first time, and so I had them on there. And we've been, a lot of us been banking in the chat room, I think today, off of that, like $40 on the way. And I was kind of telling the guys this is what I'm looking at. If you look in the Facebook group, I actually posted my results in there too. But yeah, we just kind of been talking about this stock all day in the group chat. So look at even Mike knows that it's forming an ascending triangle. uh, you guys are too much. But yeah, so let me pull it up here real quick and we could take a look at it. We actually just drew it here. So that was kind of a perfect example. you guys get to see an actual ascending triangle, how we just drew it. And you might be asking yourself, at what point, did this become an ascending triangle? Well, really, it became a ascending triangle when you drew the actual, points here from starting from the opening bell, not from pre-market, but from the opening bell. And you can pick again your time frame of when you start to draw and plot your, support and resistance. That support and resistance there showed us that this thing was forming an ascending triangle. Pretty easy, right? So we want to look for that break, and I definitely hope it goes to 40, like Sally said. And like like Brent says, Sally has spoken in the group here. So yeah, um, Sally's funny, man. She's a good trader. A lot of traders that are good seem to be female, for some reason. But anyways, let's get back to it. The ascending triangle, that's what you're looking at. So you pretty much follow that guide right there, and that shows you how you know, see the ascending triangle form. We get that break, we can look for it to start to form another level. Me as a trader, what I would do is try to enter in, at the 37 and look for the break, but I'll have a risk tolerance of maybe a couple dollars depending on your risk tolerance. We're not going to go into all that. That's a little bit advanced. But anyways, when you're doing your technical analysis, that's what you're looking at for ascending triangles. Let's see if I can pull up one for the next one here, which is descending triangles. So when you're looking at a descending triangle, you're looking at, a downtrend happening, then you're looking for some consolidation, and you're looking for the highs becoming lower. So lower highs, lower highs, lower highs. As you can see that right there. And you have a flat line here where it's bouncing off of, trying to, test that consolidation, and eventually it'll crack and break down. Um, Maybe, let's see. Trying to see if I can find a real life one for you guys here. Let's try. I'm sorry, I'm just winging this, guys. I didn't have, time to do the research and stuff like that too. Oh, this is perfect here. SQQQ. Look at that. That's one right there. So let's start from, the beginning. This is pre-market, but we're just going to focus on, the opening bell, okay? Like I said, it's good to kind of notate. Let me make it bigger for you guys. It's good to notate the highs and the lows of pre-market or whatever time frame you're trading in. It's good to have that. So we'll just do it for, technicality purposes so you guys can learn properly. You can actually extend it through there if you want to. So that's pretty much that plot, but you also want to do this here, opening bell, and the low points. Pretty easy. Oops, sorry. Actually, that probably would be the easiest. Yeah. And then you can see here, it's just consolidating. The reason why you're drawing another thing here is because this is where it's breaking the trend. Sorry. I keep moving this thing incorrectly. Boom. Some of you guys might be better or quicker at charting than I will, but sorry, I'm getting a bunch of messages. But yeah, that's pretty much what you're looking at there. Voila. Okay. Now, pretty much with like descending triangles, they're going to usually be going through periods of consolidation. And if they consolidate like right here, and they don't continue to break and they don't break down, then you're going to be expecting that reversal will happen. And once that reversal happens, then you're going to see it begin to form a pattern change. That's of course where you cut your losses if you're shorting. I'm not going to go through all that again. That's more, advanced stuff. But in terms of charting, that is what you're looking at. Okay. Um, this right here would have been a failing descending triangle because it didn't complete the breakdown. Should have been right here where it would have happened, but it didn't, and it broke out of the trend. Okay, so that's just one example, um, of a descending triangle forming, but not actually completing. And as you can see here, you want to look for that. If you're a breakout trader, you want to look for that. If you're not a breakout trader, or if you're a trend trader, then you would have, known to do whatever fits your strategy. Okay, but that's typically what a descending triangle would look like and how to draw it. Bloop, bloop, bloop. Pretty easy. Okay. Let's look at another one here. Head and shoulders pattern. Okay. This is a very, this is probably one of the hardest, this was one of the hardest, I think, patterns for me to learn, to try to learn. I always heard traders talk about it. So with the head and shoulders pattern, what happens here, you'll have some type of, you know, new high, higher low, higher low, higher high. Basically, the stock was at first in an uptrend, then it forms a neckline where it's bouncing off a previous low point, but the new high is getting lower. And then when it comes back down here and it breaks, this right here is the head and shoulders. You're looking for that. What kind of gives you a key signal to see the head and shoulders is that when it comes back to testing this, new high and it gets low, or it's right around that range of where the previous high was before the, the previous high, that's kind of an indication that hey, this thing is about to fail and break down. Um, Sorry, I'm looking at Snap is at $38 right now. It might actually hit the 40. Sally the Wise Owl. Anyway, so that's what you're looking at. This is what's called the neckline. So with the head and shoulders pattern, what's really key to look for, I've noticed has been these two highs and that that low before you can start to anticipate a breakdown. I don't know if I can find one that's has a head and shoulders pattern for you guys in real time. There's some video. I'll try to put the link in the description if I can find it. But where I did a review and it showed the head and shoulders pattern, it's much easier to see it in real time when you're looking at high points and low points and anticipating that. Because when it comes back down here, if you notice that this didn't, this next high didn't go as high as this one, you immediately want to look back at the high before that and see if it was in that same range. And if it is, watch for this next low test and see if it's going to break down. Okay. And then you can start trading from there. Um, Man, I wish I could find you guys a head and shoulders pattern to do in real time, but I don't think I can. Or I'll try to do it in the next break and just put it in the video for you guys. So anyways, head and shoulders pattern. It's an easy reversal pattern to understand. Because you can see why is it called a reversal pattern? Because in the beginning it was trending up, and then it got tired. People got tired of buying it at that price and started to say, hey, I only want it at this price and nothing more. So that means, guess what? The trend is about to reverse and come back down and maybe even break down even more. That's a reversal pattern. All right. And I know, don't worry about these right here. These are volume bar lines. We haven't gotten into that yet, but we're going to get into that yet. You guys are going to see how this is all playing out with your technical analysis so you can be able to analyze, stocks properly. All right. Doing technical analysis. This right here is an example of, price chart breakout patterns that you can look for. It's kind of similar to what you've seen in the last video, different patterns. I do a lot of videos on like the wedges and the flags. Um, so you guys can kind of, look at those videos whenever you have time. Here's an inverse head and shoulders. Um, Practicing these strategies and, or practicing these patterns and just kind of tracking them, guys, is very useful for you as a new trader. So I encourage you to try to do it whenever you can. And the free platforms like TradingView. I mean, I remember when TradingView wasn't even out. I was trading. I wish I would have had that thing. It's a great platform, but you still have things like Thinkorswim and stuff like that. Um, My only issue was when I was trying to do charting patterns and stuff like that, I wasn't sure exactly when to put you know, the line and draw the line, like what time frame to do it and how do I do it and all that good stuff. So hopefully this video will help you guys not have to figure that all out by your own, or not just look at some guru draw some lines and stuff like that on there and be like, what the heck am I looking at? Okay, I understand this is a pattern, but when am I doing this? How am I doing this? What point do I start? What point do I exit? You know, how do I know for sure that this is a pattern? I want this video to be able to do that for you guys, okay? So these are just some examples of some breakout patterns. And as we're going along, you can be like, oh, okay, that makes sense to start from there, or that makes sense to end there, vice versa, okay? So guys, let's kind of recap here. We'll take a quick break. I'll probably see if I can find a head and shoulders video to put in here for you. um, so what we pretty much recapped here, what we're going to recap here is the chart patterns we went over. We went over bullish type chart patterns, we went over bearish type chart patterns, and reversal type chart patterns, okay? We went over the types like triangles, head and shoulders, all right? So you kind of get a little gist of how to, plot that and see that. And then we talked about breakout patterns and the different various patterns we looked at on the previous slide. Okay, it's a bunch of different patterns. So just kind of getting familiar with those patterns is going to be great for you. All right. Um, Again, the patterns are formed from drawing your support and resistance, which of course is formed from you knowing where your candlesticks are, being volatile and setting high points and low points, and you plotting those high points and low points for you to perform your technical analysis. You see how all that part is coming together? Wonderful, isn't it? But a lot of information. So, guys, let's take a quick break here. We're going to recap everything and gather our thoughts because from here on out, it's going to get probably a little bit more complicated. And these are the parts of technical analysis that I didn't learn until later on that I wish I would have learned a lot sooner. Probably been a lot better of a trader that you guys are going to get here today for the free. All right, let's get ready. All right, guys, we're back at it again. So let's continue on with technical analysis. All right. So you guys have gotten that recap, which is great. Now we're going to move on to indicators, all right, and isolators. We already know what patterns are when we do technical analysis, which is great, but we need to find a way to be able to begin to establish, to look at those patterns and find those patterns. So this is going to help us be able to do that, okay? So here's what a lot of, I would say, like, online guru teachers and stuff like that don't really kind of teach properly, from what I've seen. Um, or, if they do, they leave out a lot of information that you probably should need about it. Um, and for beginners in learning about technical analysis and learning about the stock market or any kind of market, they can easily get this stuff kind of mixed up. Or just kind of think that because they've seen one video about one indicator, that's all that they use. That's the magic formula when it's not. Okay. So let's just kind of break this stuff down here together so you can kind of get a better understanding of everything. For indicators and isolators, well, first and foremost, what is an indicator and an isolator? Indicators are basically statistics that are used to kind of measure current conditions, as well to be able to predict, future financial economic trends, basically. So basically, it's just signals or signs and stuff that you see that, come from some type of mathematical formula that can help determine, the status of any kind of underlying security. Okay. Um, More specifically, though, oscillators are, something that can assist traders with determining whether or not the particular security that they're looking at is either being overbought or oversold in different conditions. Um, Most traders, they'll use multiple oscillators just to kind of confirm, markets. Um, Ranges from from different extremes determining on, and they use it to kind of help determine entry and exit points as well too. So isolators are, technical indicators that, typically range between 0 and 100. um, and they usually have them reading inside like closed value ranges. Okay, so just kind of know that usually when you're looking at the oscillators. And here on this, section here, I kind of broken down the different indicators and oscillators. um, we're not going to go over the mathematics on each of these because we would be here for a very long time if we did, and me explaining that to you. You can look it up on your own time. Sources like Investopedia are really good for you to kind of, get the mathematical formula. Just type in the indicator or the oscillator, and it'll usually give you the actual mathematical formula if you want it. And keep in mind what we kind of go over as far as the numerical values, those can be adjusted to each trader. So when I mention something like the simple day moving average, you don't have to go based off like, the numbers that are there. You can always adjust them if you need to, and you'll see what I'm talking about in a second. But let's talk about the different indicators. They have the volume weighted average price, the VWAP. They have the moving averages. The simple one is SMA, simple moving average, and there's the exponential moving average, the EMA. There's Bollinger Bands, there's Fibonacci retracement tools, and then there's HMO clouds. So those are kind of like the main indicators that are there. Then the oscillators are relative strength index, the moving average convergence divergence, standard deviation, stochastics oscillators, and the average directional index. Now, guys, understand these are not the only ones that exist. There are literally hundreds of different types of indicators and oscillators. And in fact, I'm going to do a full entire video on all the ones that are there. So you guys can watch that, whenever you have time. And then for you guys that have the course and stuff like that, I'm going to show you how to put these, different ones together, and you're going to have like a detailed, um, you know, PDF kind of thing to be able to know which combination is going to be the best fit for you to give you the most accurate readings and stuff like that. So you guys can have that. Um, but yeah, so that's pretty much what we're going to cover here is just these. Now, I'm not going to go over each one of these individually. We'll just touch on like maybe two or three indicators and then two oscillators and kind of wrap that up in, you know, our little recap here, and then we'll move on to the next section. So let's talk about the most important one. I personally feel, and what a lot of traders feel is the most important one as well too, is the VWAP, the volume weighted average price. And I can't believe this is not talked about in a lot of videos, or even when people are drawing like chart patterns, stuff like that. I mean, I get it. They're probably just trying to focus on maybe the actual, you know, subject. But I feel like you should have the volume weighted average price listed in almost anything you either recapping or drawing or showing, because it's a very, very important tool. And literally almost every trader uses it, because the volume weighted average price is basically a trading benchmark that traders use that gives you the average of the price of a security and how it has been traded throughout the day based on both volume and price, which is very important. And it's important because it provides traders with, like the insight of the trend of a security, and pretty much it simply tells you if it's bullish or bearish territory. Okay. And me personally, a lot of my strategies go off of that, which helps me out with, risk management. Okay. And why is it important? Because, traders who use it, they see it as kind of like a smooth indication of a security of price over time. And it's also used by large traders too, who need that just to ensure that their trades are, move in the direction that they're trying to get it to move in, whether they're trying to buy or sell. Okay, so that's really why it's kind of important, um, to have a VWAP indicator to kind of know where you're at with the you know volume weighted average price. So if you kind of look at this photo here, this is kind of showing you an example of the VWAP. Like I said, we're going to do real time setups of this so you guys can know how to do it, but just kind of go off the pictures here real quick. So right here, this black line is the VWAP line, where the actual volume weighted average price is, holding at. This right here is the upper band standard deviation, the lower band of standard deviation, but coming from the volume weighted average price line. And this is just kind of showing you how this might trigger an order, if you have a, order placed for when the VWAP is touched. Okay. Um, don't need to worry about the standard deviation band or the lower deviation band. You can, if you want to, use that. If you, I don't ever use it, but if you want to, you can. That's great for you. So that's pretty much, the volume weight average price. Very, very important indicator to have, in my opinion. All right. I really don't know any successful traders who don't trade with it. Simple moving averages. Well, let me kind of go over this real quick too, because a lot of people ask this, what's kind of like the difference between the volume weighted average price and a simple moving average? The simple moving average basically kind of provides retail traders with, like a less volatile view of the recent price. Um, Unlike the volume weighted average price, it doesn't, the, unlike the volume weighted average price, the simple moving average doesn't really take into account levels of volume in the trading security. They just worry about price. They don't really worry about volume with the simple moving average. So that's kind of one of the differences as I go over, the simple moving average. You guys will understand. Um, and that's just because, the VWAP weighs in each day's price change by the amount of volume that's occurring in that day. All right. The simple moving average simply just, takes into account, the trading days that have the same level of volume. Hope that makes sense. Let's go on to simple moving averages. So moving averages kind of consist in two different fashions. There's a simple moving average, the SMA, and then there's the exponential moving average, the EMA. All right. We're going to focus really quickly here just on the simple moving average, the SMA. Um, the reason, for calculating this is just to kind of help out with smoothing out the price data, and, consistently, by creating a consistent updated version of it. And you'll see here in this photo, this blue line here is an example of the simple moving average. So obviously you know what the candlesticks mean, right? The candlesticks is showing you the price change between one point and another of a security, what the price was. Now, if you see that the candlesticks are below that simple moving average line, that means the price is trading below whatever time frame you have or whatever day frame you're using with the simple moving averages. Okay, so the simple moving average is calculated by taking the mean of a given set of values over a specific period of time. The most common time frame that people use with the SMA is going to be either the 15, 20, 30, 100. Probably the most popular is 200 moving day, the simple moving average. That's just kind of showing you the time frame. So like when someone says, oh, the price is trading below the 200 SMA, that means the price right here is trading below the last 200 days of the moving average of the actual stock. So that means that could, signal to someone that, this is a good point to buy because it's very, very low. Okay. Again, that varies from person to person and strategy to strategy. You know, Me personally, because my time frame, I don't trade in the 200, but I know a lot of successful traders who do, especially the swing traders. So that's something to keep in mind. All right. We are almost at 40 with Snapchat. All right. Sorry, I just keep watching it to see if Sally was correct. So that's pretty much a simple moving average, guys. Okay. Pretty easy. Pretty easy. Next is the exponential moving average. That's kind of the formula for the exponential moving averages. So the exponential moving average is it gives more weight on recent price change in an attempt to make the price action more responsive to new information. So the calculation on EMA puts kind of more emphasis on recent data points than the SMA does, um, because it's considered a weighted average calculation. Short-term day traders like myself typically rely on the EMA, the 12 EMA or the 26 EMA. I think it's 12 and 26 EMA, and then there's like the 8 and 20 day EMA. And what I mean by that, guys, you can adjust those. Like some people have like a 9 and a 5 day EMA. The more you adjust it, as far as it calculating the moving averages over a time period, the more fluctuation can be in the line. Okay. Some people customize it, some people don't. Me, typically, I use a standard. I don't really, because I trade within a range. Don't worry about how I trade. You need to focus on you. Is how I do it, but you can do it however you want to. Some people might suggest, the 50 EMA. Some people might suggest the 200-day EMA, which are better suited for long-term traders or investors. It all depends on your, preference of trading the security you're looking at. Okay. So exponential moving average, great tool. Again, I use it as a day trader. I rely probably more on the EMA than I do the SMA. All right. but I still use it as confirmation with the SMA. Still a good tool. Um, so what's the difference between the two? Kind of, break it down. Um, the, the exponential moving averages is, a type of moving average that gives you more weight on recent trading days. And this might be more useful for short-term traders like myself, who trade on a day-to-day basis, or, who might want to, focus on recent data points, especially when something like a catalyst is happening, and things like that. Whereas longer term data, like what happened in the last 200 days, I don't really care about, would not benefit me. Now, the simple moving average is, on the other hand, is calculated by averaging a series of price equal to, the weight given to each price that's involved. Okay, so that's kind of the biggest difference, and it's built for like longer time frames. It's just more of a broader version of the price change of a security. Hope that makes sense. EMA is more recent. SMA is more, wider range. Best way to kind of put it. Okay. So those are two indicators. Let's take a quick second here and put those on the actual chart. So I know we are still looking at Snapchat. Let's pull that up here. Look at that. Ascending triangle, and there's a breakout. Boom. Sally was right. It's going to hit that $40, I think. But anyways, so let's go ahead and add these on here. Eric, how do you add the EMA and SMA on there? Easy. You can click on indicators and trading view. You can type in simple moving average. Usually it's like the top one. I mean, it really doesn't matter. You can kind of add, different ones in there. I believe they have like standard ones too. But it's up to you. You find out which one you like, and put it in there. And then let's do well, let me clear it out here so we can make sure we see it. So now you see like all these lines and stuff like here. This is kind of showing you the different, close. This one is a 20-day, 50-day, 100-day, and I don't really need all those. If you don't need all those, you can close that out and add a different indicator that you might want. Because when you type in simple moving average, you'll see there's a bunch of different, like I said, strategies to do. And they'll usually list like what days they're doing it. Again, whatever one is more beneficial to you, you can kind of look them up, or you can kind of create your own with TradingView. That's what's pretty cool about TradingView as well too. Let's look at the 16 to 20. That way, it's not like a lot of stuff going on for us here. So you see here, this is showing you the blue line and the red line. The red line is the 6 and the blue line is the 20-day. Okay. Now you can also change this, I believe. Let me click on this here. The color, if you wanted to. But let's add the EMA. See what colors they give us for those. Oh, exponential moving average. Boom, tentacles. And now that's added on there. And you'll see the EMA line is, let me zoom in a little bit more so you guys can get a little bit clearer. That blue line right there. Um, sorry. Let's change these colors here so it's a little bit. Oh, let me add the VWAP too. Kind of want to add these as we go. Volume weighted average price. All right. So let's close that out. Now, if you click on this and go to the settings, I like my VWAP to be a yellow color. I don't know why. I feel like it just kind of tells me to slow down, and I'm gonna get rid of the bands because, like I told you, I don't care about the bands. You can keep them if you want it. Um, that's up to you. Oop, settings, VWAP yellow line. Okay, there's my VWAP. Okay. Now let's try to change the colors here of the SMA, make it a little bit easier to see. Let's make it, let's make it purple. No, let's make it green, like a light green. And if you guys don't know, the reason why I keep my background black is because it's better on my eyesight than it is with the white. Okay. So this is pretty much what it looks like adding these indicators onto your chart. So let's take a look at that. Quick step before we move on to the next, before we move on to the isolators. If you had this on your chart right now, you drew these lines and stuff like that, you drew your levels of support and resistance because you found the higher highs, higher lows, and then you added your indicators, your volume weighted average price, and then you have exponential moving averages and simple moving averages. All these signs here are indicating that this stock is in an uptrend because of the fact that it's trading. You see the candlesticks? Even though the candlesticks might be, bullish here, bullish here, bearish here, blah, 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 the indicators are showing you that the price action at this point in time is, from here is trending up. So you got a lot of bullish signals here. And this is what another reason why I felt, at this point that this stock was going to be bullish, which of course it did. If it hits that 40, why is this $40 here? Because again, that was a previous level of resistance. So that's going to be another key indicator here with Snapchat and seeing if it's going to keep holding its trend and everything. So should I draw these out some more? So yeah, because I'm not telling how long this is going to be. So yeah. So anyways, so that's pretty much how your technical indicators works. And to me as a trader, this is a good sign that this that this bullish trend is going to continue. Got an ascending pattern that I seen from drawing my levels of support and resistance. It's trading above my volume weighted average price, and it's mostly above the simple moving average and exponential average. Great, perfect. All right. So that's how you use those indicators. Now let's go take on some oscillators. And again, this will vary depending on what indicators you use. Some people might not like to look at that. You might want to use Bollinger Bands or any of the other indicators that are there for you. You don't have to use what I use. Use whatever you want. Now let's talk about the moving average convergence divergence. What this does here, this is a trend um, isolator slash indicator. It's an indicator that's an isolator that shows you the relationship between the moving averages, okay, of a security. And it's used by taking away the 26 EMA from the 12 EMA, I believe. And you can adjust that accordingly. Excuse me. When the MACD is positive, the short-term average is located above the long-term average, basically, which is this right here. Excuse me. Need some water. Now, this is an indication of upward momentum. When the short-term average is below the long-term average, then that's a sign of downward momentum. Hence this right here. Okay. And we're going to put this on so we can kind of see what we're looking at when doing our analysis. Okay. Then there is relative strength index. This is another oscillator. What relative strength index does is it measures price momentum. Okay. So what this does is measure the magnitude of recent price changes that tells you if a stock price might be oversold or overbought at that price. Okay. Oversold is when it's 30 or below. Overbought is when it's 70 and above. So when it's overbought, that's letting you know, hey, this price is kind of high for where it's at right now. It's a good chance it might be coming back. Okay, too many people bought it and the price needs to come back down. When it's oversold, it's the opposite. It means that it's been sold, it's being sold really, really cheap. Buyers are going to come in and think this is a good point to probably bring the price up. All right, within that specific time frame. So Eric, what the heck is the difference between the RSI and the MACD when it comes to stock market? Well, me personally, I use both. Okay, and because of just the different things that they tell each other. So the relative strength indicator that signals whenever again the price is you know overbought or oversold based on the price levels. The RSI oscillator just kind of calculates like the average gains and losses over a period of time, and I think by default is usually like 14. I think it's like a 14-day period, whatever. But the values themselves, as you've seen with the 30 and the 70, goes from 0 to 100. Okay. So just kind of understand that. That's a good thing to know. And it's like that typically with any oscillator. The range will be from 0 to 100, whether it be this RSI or any other oscillator you use. That's usually what it does. The MACD usually measures the relationship between the exponential moving averages, while the RSI measures the recent price change. So that's kind of the difference between the two. Often, many analysts will like put them together to kind of get like a more technical picture of the market. But both of them measure strength. Well, both of them measure momentum in the market, whether it's strong or weak, for any given security or the market overall, however you're looking at it, or whatever you're looking at on your chart. Um, because of the fact that they measure two different factors, sometimes they can give you contrary, conflicting signals. So keep that in mind too. Um, a lot of traders don't understand that, and that takes a lot of kind of practicing and looking at those indicators and understanding the market you're in and the security you're looking at. Um, if you're going to look at both of them, they can definitely give you conflicting signals, and you won't really know which one to kind of go with. Okay, so understand that. Um, and then there is volume. Okay. Basically, volume is just the amount of shares or orders that are executed at a specific period of time. Um, and volume is usually visible in a few different ways. You can view it down here. You can also you can view it right here through the price visible range on the side. I like to do both honestly, but it's two different ways of looking at the same thing really. Um, where one is kind of showing you like the price, and this one's showing you the amount at the date and time. So I personally use both, but whatever, to each his own. You don't have to do that. Okay, so let's go ahead and put these oscillators onto our chart and see what we can understand. Same thing like before, you are going to put on indicators, and let's add MACD first, moving average convergence divergence. Boom, there it is. And then let's add RSI, relative strength index. Oh, it's been updated. Oop, there it is. All right. And do we have any volume bars there? Let's do volume profile. We're gonna add the visible range. See, there it is on the side. And then I don't think, let me make sure. Where's the volume bars at? Let me type it in. If I can't find it, then we'll just skip it. Nope, that's not the one I want. Let me close out that oscillator. Boom. Where did they move it to? I think they changed it. It's fine if it's not there. Usually, like some charts will come with it default on there. Um, Booyah, it was on there. There we go. So there's the volume bars right there. So let's kind of analyze this. See, when you look at this here, this is a lot of information for someone who wouldn't know what they're looking at. Don't worry about this red line here. That's just kind of showing you where most of the volume happened at a certain price. Okay. So 36.99 might be a good level of support for someone, um, vice versa. The good thing about this here too, guys, because this is where a lot of traders, end up getting faked out because they see a price go down and they didn't get the stock time to play out. But I really don't want to get into all that because that'll be a whole nother lesson for you guys. But anyways, so we got our oscillators out of it. Typically, you could tell something is an oscillator because it's going to be down here at the bottom. So like I said, if I would have had something else there, it would probably read the same information just in a different way. Okay. Usually your isolators are down here. Indicators go on the actual chart itself. So it's good to have a combination of indicators and isolators to help give yourself a much better technical picture. Now, what is this telling me here? My indicators are telling me, from the support and resistance, this is still in the upwards trend. My moving average convergence divergence is telling me that it's starting to pull down here on the downside. And then my relative strength index is kind of in the middle. It's not really overbought or oversold. It's kind of at a good support level there um, for the price over the last period of time. So what I can kind of tell from here, and what I was kind of predicting anyway, was that um, Snap was going to make. Oh, sorry, didn't mean to move that. Snap is going to make a new level of support here, a new recent level of support. So the reason why I can tell, and then you can see here that the volume has died off. Okay, and so I want you to be able to read all these technicals and see and kind of understand what's going on here all together, kind of put the whole picture in perspective. Okay, you see it's a bullish signal or a bullish pattern. Okay, you got you got that there. You got a good level of support because this is telling you that this is kind of like a mid-range slash bottom. This is telling you it's at the bottom end of the moving average convergence divergence. And this one's telling you that there's a little bit of volume there, not as much in the beginning as it usually is, but it's volume has died off a little bit on the price. However, all these things have died off and, volume has died off. The moving average convergence divergence is at a low point. The relative strength index is kind of midway slash low point. And then the volume and the price action has moved up to here. This is telling me that this thing is in a good, strong position and it's about to establish a new level of support, more than likely, because look, the new highs has been broken, and now it's telling me that hey, this is starting to become a low point based on these indicators. Hope that makes sense. Don't worry, you do this enough, it'll start to make sense. But this is telling me that hey, new level of support is forming right here. Now, if this cracks this new level of support, then it's time to draw new lines and start plotting a new trading strategy, formulating a new plan. But this right here worked out just like I planned it would, just because of all of what happened. Okay, me doing the watch list, me reviewing, me staying up to date on the news, looking at the potential, measuring the lows and the highs, considering where to get in and where to get out, blah blah blah. You can see all that on my you know on the post that I showed you with the my Snapchat results of trading it. Okay, so that's pretty much what you're looking at there. You know that's why having indicators and isolators are important. Like I wouldn't know if this was going to be a new level of support if I didn't really have isolators to tell me that the price strength and the volume strength is starting to light up and the price is hanging where it's at now. My indicators are just telling me that it's forming, new price action. It's not telling me is the trend holding up, and that's what kind of these are doing. So I hope that makes sense. Now we've done technical analysis on that. Okay. Um, let's go back to where we were at and do a little quick recap. Now that we put all that together, what we learned here so far? We learned what indicators and oscillators are. Okay, we know one goes on the chart, one goes at the bottom. We know the differences between the two. We learned what volume weighted average prices are and why it's important because it tells us that the stock is in a bullish territory or a bearish territory. Okay, we learned what moving averages are and the differences between them. We learned about the simple moving average. We learned about the exponential moving average. We know the most commonly used ones is the 200 for a simple moving average, and then 2612 for exponential moving averages. We know the difference between them. We know day traders use those more than day traders use EMAs more than SMAs on average, but again varies from trader to trader. We learned what moving average convergence divergences are, how it tracks the trend and shows the strength of the trend that it's in. And then we learned what relative strength index is and how that determines if a price has been, if the price of a security is overbought or oversold. at a given point. And then we learned about the different ways volume affects it. It shows you a lot of traders have been trading at that price, or if it hasn't, and the different ways to plot those. Okay. This is probably the most information you got in a little bit of a section. So, guys, take your time, recap, digest that, look at how I, visualize that. Of course, if you do it on your own, if you have a quick question, definitely shoot it over to me, email it to me. I'll take a quick look at it and say, hey, yeah, you're right in your thoughts on this, or, et cetera, et cetera. I'll look at it with you if you need to. But yeah, I understand it's a lot of information. And trust me, guys, it took me years to kind of figure out this stuff. To find it, first of all, it took years for me to find it. And then it took, plenty of times for me to practice for me to kind of get it right. Okay. Um, and I've seen some traders touch on it a little bit, but not too much, not enough for you to kind of know exactly what to do. So I'm trying to walk you through it little by little, step by step. But you'll see how the overall big picture is playing out. Okay, so let's take a quick break here, recap this, and then we'll come back to wrap up the rest of everything and the technical analysis veterans. All right. All right, guys, let's go ahead and wrap this part up here. So, like I said, we went over, pretty much the whole thing of technical analysis, honestly. This next little part here, it doesn't really apply to every single trader. So we're gonna just, touch on it a little bit, not too much detail, but enough of it to kind of understand that it does, contribute to somewhat to technical analysis, okay? So you guys know how to, plot support and resistance, the differences between oscillators, indicators, VWAPs, about chart patterns, about you know, specific, indicators and oscillators. You learned a lot. However, and I noticed this in a lot of different places that that's not all that requires to be, knowing about technical analysis when it comes to the market. Okay. Um, this is just something that you want to know as a trader. Okay. So let's kind of get into the last little bit here. Finding stocks. All right. Believe it or not, but finding stocks is, or just, whatever you're looking for in general, it is a form of technical analysis that, you know, in itself, because of the fact that you have to actually filter out for different criteria that you're looking for and find stocks that fit your trading style and goals. Okay. Um, and to be honest with you, this was probably the longest, maybe hardest part for me as a trader during my trading career, especially in the beginning, because I would either find stocks that, already ran and it was too late. Um, I didn't know how to filter, for what I needed. They've already ran up or ran down, and I would constantly lose money just trying to play them. Okay. Never really worked out well for me, unfortunately. Just, and it's nothing wrong with that. It's just the fact that that wasn't really my trading style, and I didn't know it at the time. But you don't know what you don't know, right? So, I mean, obviously now I don't have to worry about that because, I have the alerts that come, they just alerts come and then I go make my trade and plot, accordingly. And we also have in the chat room many traders helping us out to find out interesting stocks as well too. Um, so that's one way to just kind of look for finding stocks. So people always ask, is this the only way to do it is by paying something? No, you can definitely find stocks that you want to trade for free. There's scanners out there like Finviz. There's ones that in your brokerage firm, or whoever you're trading with your platform. Like Thinkorswim has a really good scanner. Weebles isn't that great. So I mean, it just depends on what you want to use, but there are free options out there. The only thing, however, and I've noticed with free options is that you'll either find the stocks too late after they already ran, um, and you're kind of missing out on what you could have gained. Or ultimately, too, for another thing, you got to actually know what you need to filter out for the criteria, which requires you to know the technical analysis that you're looking for. The thing with paid scanners, I mean, most paid scanners that are good, and most of them are good if you got to pay for them, but essentially they all kind of work the same. The difference between them is just the criteria you can search for. Most of those things cost money. Uh, Not only does it cost money, but it takes time for you to learn how to code it and what you need to put in there to get the right stocks that you want. I mean, there's like trade ideas, there's scans. I mean, there's a lot of different, stock scanners out there and different ways to filter out that criteria. But they're very expensive. They're like $100, $150 a month. they get very expensive just to scan for stocks. Okay, and people, especially when you're starting out trading, you don't really have that money to throw, that capital to put in towards, trading and stuff like that, which is why the alerts exist, to help you guys have that power, have that tools that, professional and paid traders have without having to spend so much money. I mean, the alerts are very, very cheap. So it just, points you in the right direction, just like how the scanners do to go look at the stock that's going to have the potential to run. So, but technical analysis is required to, be able to scan and find the stocks that you want. All right. So keep that in mind. Now, this part right here doesn't really apply to all traders. Okay. So I'm going to kind of go, I'm going to just touch on a little bit. I'm not going to go into detail. There's going to be a whole video that I'm doing on level 2 for those of you who have the course. You can, check it out in detail there. You'll learn a lot more. But right now, I'm just going to go over a little bit, only because of the fact that it doesn't make sense for me to go into super detail with it if not every trader is going to need it. This technical analysis course is supposed to be for every trader, but this part here isn't going to be for every trader. So, excuse me. Now, level 2 and advanced indicators. Here's what, many traders don't tell you about technical analysis, I would say. They'll touch on level 2 and things like that, kind of go over it, but they don't really tell you like details about it. And that is a part of technical analysis. You would definitely want to combine, if you're a day trader, you'd want to combine this with, your technicals that you use. And here's the reason why. So everything that you learned so far, as far as doing technical analysis, plotting, charting, doing all that stuff, understanding the indicators and isolators and things like that, studying the chart patterns and all that good stuff, that's all fine and dandy. However, you got to keep in mind that those are all lagging indicators. What I mean by that, it shows you what happens in the past. It's not going to show you what's potentially going to happen in the future. It's not guaranteed. It's just an estimate, but it also, isn't very sound, too soundproof as being able to actually see what's coming up. So a lot of, you know, gurus and people won't tell you that concept to understand that it is a lagging indicator. Okay. And some traders get burnt out a lot, trying to use it as a predictive indicator when it doesn't help. And which is why the many traders think that it's just nonsense. They'll get the sense that because of what happened in the past and what's been charted doesn't determine what's going to happen in the future and how traders will feel about it. Because you got to remember like how I told you guys before in the other videos as well too, that the market is the movement based upon psychology and emotions. Okay, you can't forget that. And so that's why some traders are like, oh, technical analysis is BS because it's not gonna, determine how a person is gonna feel about it in the future. And you can kind of say that, and you can kind of not say that. The good thing about level 2 and price action is that it shows you how people are feeling about the value towards a stock, because that's what it is. That's what technical analysis is, analyzing the price. And level 2 is showing you what prices they're trying to move that stock to, and that's going to determine how they feel about it. So again, I'm doing a whole other video on level 2 technical analysis. We're just going to touch on this um, for little tips and tricks, and you know, just so you guys can kind of get a quick rundown. And the reason why this isn't needed for every trader is because of the fact that this is on a very, very micro scale. Not all traders are going to need this. Okay. Um, this would really only apply to people who are day traders who fall into the category of being like a daily pivot trader, a fading trader, scalper, or like me, a momentum trader. Um, you would want to have level 2 and understand how it works and stuff like that. And if you're not one of those traders, you can kind of just skip on this part of the video. But this is why you know you guys can actually tell right now, real time, that I missed out on gains with trading Snapchat. I had to cut it because I'm doing this video to try to teach you guys this, and in that instance, I'm missing out on gains. Um, and understand too, that's because I get this question a lot. That's why gurus charge so much, because people always ask, why does it cost so much for someone to teach me? Well, I would make a lot of money if I wasn't teaching you. There's the opportunity cost there. Um, for me doing this video, I probably lost out on thousands I could have made with Snapchat if I would have traded the way I traded. Um, whereas other people were making it, and I'm out of the trade because I had to come and do this. Like for example, as a matter of fact, let me pull this up here because I think is she done? I think like Sally made like a couple grand on it. Derek did too. Yeah, I mean, look, Derek made 6 grand on it, and it didn't even hit the 40. Like I told you guys, it was gonna go to 40. I think Sally did wait until it hit 40. She got paid like bank. She went in good on that. Look at that. She was up 13,000. She wanted it to hit four. So now she probably, yeah, she went home with like 40 bucks or sorry, $15,000 is what she was up by. So yeah, congratulate her on that. So that could have been me in that trade, but again, I'm taking the time to kind of show you guys I did trade Snap, but I didn't have time to wait for it to hit my goal like I planned. As a matter of fact, let's pull it up right now so we can kind of see where it's at in that technical analysis. Yep, see, it did what we thought. It broke out and then touched 40. Went exactly to 40, like I said, like what other people in the chat room was saying. And then it's starting to pull back here. And you see here, this is exactly what I wanted to see, establish a new level of support, which it did right here. And I can tell that because it was pulling down at this point. And that's, excuse me, at the lower end of the RSI and the lower end of the MACD. And now as long as it bounces here, that's fine. But what you want to see at this point, this is where a head and shoulders pattern might come in. All right. So we broke the previous days after hours high, right? Boom. And then it started to pull back. Now, if it doesn't break that high again, you want to start looking at the reversal pattern and it coming back down. That's a key indication there. So this would have been a good head and shoulders play like I was trying to show you guys before. You had the uptrend here, breaking a high. Now it's pulling back. Now let's see if on this bounce here, how high it gets. All right. If it continues to trend, that'd be great. But if not, and it didn't pass, look for it to snap and break this level and you can trade accordingly. So I just want to throw that in there. But yeah, so this thing played out perfectly. Man, you guys got to see this real time. So this is how it works every day in and day out on technical analysis on that part. Okay. So pretty simple. Um, but guess what? This is the stuff I teach you. And Sally, she has a course, so she learned this. This is probably why she making why she made $15,000 today. I only made like one. But anyways, if you're a swing trader, you don't need this. You don't need level 2. You don't need time and sales. You don't need a price ladder. You'll be fine. All right. So this is more for day traders and interim traders. So what we have here, basically, this is the tape. Oops, sorry. This is the tape. This is the price ladder, and this is level 2. So level 2 basically shows you the current bids and asks, the buys and sell orders that are closest to the price for the market makers to exchange, and execute orders. If you don't know what I'm talking about here, go back and look at the video about getting started in the stock market that explains all that. Okay. But the good thing about level 2 is that it shows you orders that are coming up next to prices, that are there. So when you see like big orders, that could potentially give you some idea of level of support. So I'm watching these get filled, right coming through here on level 2. This is what they're waiting to line up and execute. You got, 505 orders here at 430, 433.80, and then 63 here at 43.40. And this ladder, this pretty much moves up and down as the orders get executed. And the reason why I have the price ladder here is because it kind of helps show the sliding scale of the price between the stock as it's actually being executed. And the time and sales tape is kind of the same thing like the price ladder. It shows you the actual orders getting executed. Now, why do I need the price ladder and the smart tape when you have level 2 here showing you the different orders that are coming through and getting filled and stuff like that? Because a lot of traders also will use this to see, oh, this is a level of support and resistance. There's 1,355 orders that need to be executed here, but it's not 1,355 buy orders to exit there. So it might be hard for us to break between that $34 price, right? Now you don't know for sure because this can also be a fake order. Sometimes traders will put that order in and then they'll take it out because they want people to stop putting in buy orders so they can short the stock. Okay, sometimes that happens, or vice versa. It's a very psychological thing that we go over in level 2 uh, video. But that's pretty much why you want to have the time and sales tape because that solidifies what has been executed on the actual exchange. So that's something to keep in mind. Okay, pretty easy. All right, so putting it all together, that's what we're going to do here today. I'm going to walk you guys through the technical analysis, even though we kind of just covered it. I'm going to cover it a little bit more. talk about how we want to predict the outcome of the price movement and how to profit, and just kind of put it all the pieces together for you so it makes sense. Okay. Um, and then I'll leave you guys with some tips and tricks, and you'll be good to go for the day. Sorry about any noise you might hear. They're doing construction outside my building, but that's kind of how it works. All right, so um, putting it all together here, let's take a look at Snap and see how we put this together. I mean, even though I kind of walked you guys through it here today, Snap is a larger cap stock. I don't usually trade large cap stocks like that because of the fact that they take so long to play out, and I need, volatility and momentum to happen quickly for me to, you know, trade properly, or else I begin to get impatient. But this would have been a good day. I'm not saying I have to do that, but I prefer that. But this is one of those ones where it played out perfectly. If you're a newer trader to the market, I suggest starting out with slower moving stocks and larger cap stocks so that you can kind of get a feel for doing all this at a fast pace until the point comes to where you can just look at it and see it all in your head because you've seen it so many millions and millions of times. That's kind of how I am sometimes. But let's put it all together. So we got first thing we had to do was what? Support and resistance. We found those levels, okay, support and resistance from a time frame that we wanted, which was the minute time frame. Okay. Now remember, it's a good idea to have two different time frames. If you start with the 1 minute, you want to have one larger. If you start with a 5 minute, you want to have another one larger, just so you kind of get the confirmation of what you're seeing. Because sometimes movements might happen within that 5 minute time frame that on the 15-minute time frame shows that you should have stayed in the stock. Sometimes that happens. So like for example, here we're on the 1 minute, whereas if I went to the 5 minute, it still kind of confirms what I was seeing. Okay. Whereas if I would have been on a 1 minute and probably looked at this, I probably would have thought, oh, this thing is going to crash. But if I zoomed out on a 5 minute, I would have saw it. So anyways, two time frames is always good to have. So you calculate first, again, your support and resistance level by finding your highs and lows, okay? And you draw on those lines to where they connect. At any time frame, whether it be pre-market, whether it be after hours, or whether it be during the day, you find those first, okay? Now you have, of course, your volume weighted average price to tell you whether or not it's in bullish territory or bearish territory. So you can know the odds are in your favor, whether you're going to be trading it to the top side or to the bottom side. And then you have, your candlesticks showing you different levels of resistance during a time period. For me, it's typically when, the moving average convergence divergence, shows strength and weakness. That gives me like a full time frame for a little bit. So I usually look at it like that. You have your exponential moving averages that shows you the prices, excuse me, trading higher than it was the previous days, which gives you a great bullish indication that the stock price is going to keep holding up, where it's at. And then you have your relative strength index that shows you if the price is, too high or too low given certain time periods and how that pretty much plays out. If you kind of put all that stuff together, you can, by then at that point, begin to plot and predict like, hey, like I told you guys earlier, this is showing a bullish sign. So I would wait for the breakout here. And once it breaks out and I get, you know, an idea that, hey, it broke out above that previous price, I can expect it to go a little bit more. So this would have been like a whole $1 to $2 move roughly, may even go higher just because I know this information. So I did my chart and I predicted that to happen and I played it to the upside. However, I could also wait and see if it doesn't break out that it's going to go to the downside, I can short the stock. So that's how you want to predict based on the patterns that you like to trade. Again, this will be different if you did a descending triangle pattern and vice versa. That's pretty much how that works. And then you profit. You can, when it comes to your risk and reward, that's up to you. If you want to, move 30 cents to a dollar, 50 cents to a dollar, whatever it might be, that's, how you profit. You plan when the stock begins to not go your way, if it breaks a level that's not to where you want, like when I showed you guys with SQQQ, you will cut your loss and just wait for your next entry. Like for example here, let's say if I, sorry, it's gonna load up. Let's say if I was playing this stock, right? If I was playing SQQQ ticker and it went this way and sorry, it was going like this and I'm like, okay, this is a descending, a descending triangle. I'm gonna wait for it to break here, probably like the $38 level. and I'm shorting the stock, right? Because I'm thinking it's going to go down, and I want it to go down to maybe 35 or 37 because that's where I'm expecting it to go down to. I know that if it breaks this trend line, that it's going to start to go up, and I need to go ahead and cut my losses, which I would have done right here if I was shorting this stock. Okay, so you plan your risk to reward ratio, and you can, if you want to use this little, this little short position calculator, you can. Um, it's a pretty cool thing. Like, hey, I was going to go short. This is my target, but you do that. Blah blah blah. This is a whole nother section on risk management. I'm not going to go into detail with it, but that's how you would profit. You would take your profit and call it a day. Okay, pretty simple, right? I know it's not, but again, once you practice this more and more, the better you'll get at it. And here's the thing, guys, too, don't try to do it all at once. Really the best thing to do is just spend time on one part of the section. Spend a little bit of part just trying to plot support and resistance lines, see how good you get at looking at that. Then spend some time, looking at the VWAP, seeing if you can understand the price movement and the candlesticks that show up. Can you recognize, sorry, can you recognize like hammers like this, shooting stars, things like that? Can you recognize those? Can you know, spend your time understanding that stuff, and then spend your time, understanding the relative strength index and whatever oscillators you might want to use in accordance with it as well too. These are things you want to practice one by one by one. Don't need to do them all together. You're going to get confused. One by one by one, you're just adding on top of it. Okay? Hopefully that helps. That's how it helped me. All right. So let's go ahead and knock that out. So that's pretty much it, guys. Leave you guys with, my little personal thoughts and tips on, technical analysis. Again, most technical analysis are lagging indicators. Well, pretty much all of them are, except for like level two. And level two, and order flow is like the best leading indicator to kind of predict price movements. When you can combine those two together, you become very, very, good at, being trading and managing your risks and all that good stuff. That's great, which is what I do. I'm constantly looking at level two when I'm in a trade, and I'm looking at price, I'm looking at charts and patterns. So I usually look at the charts and stuff like that and plot to decide when I might enter and when I might exit. And then once I'm in it, I'm looking at, level two to kind of see how the trade is going my way. If it stays going my way, and I get out when it's not. Pretty easy. Um, Remember, catalysts, for the price movement could vary from market to market. So for example, what happens, the reason for the price change in the technical analysis, especially if it doesn't go your way or something like that, can be for a variety of different things. And catalyst is what drives, price movement. And those catalysts can vary from market to market. Like if you're in Forex, price movement in Forex might not affect price movement in the stock market, or vice versa. But ultimately, it does depend on the catalyst. So, like, something could happen to where international conflict happens, and the euro is worth more than a dollar. Of course, that's affecting forex traders. But for me, who is trading shares in Apple, doesn't really affect me in my price movement. So understand that catalysts can vary from market to market and how it affects you. Um, Technical analysis, of course, varies from person to person. Okay. When it comes to trading strategies, traders can use, their knowledge of trends, candlesticks, indicators, and all other types of stuff to make trades. There's no right or wrong answer, or right or wrong way to do it. You want to do what best fits your style as a trader. Just because I went over MACD, RSI doesn't mean you don't, or EMA and SMA doesn't mean you can't go learn HMO Cloud or Fibonacci retracements. Those you might be able to see better. It varies from trader to trader. So, practice those and see how you might like that. Um, One big tip too, don't use too many indicators or isolators or too little. Because if you use too little, you won't get the confirmations you need. If you use too many, you're going to get conflicting signals. So you want to find that right balance that'll help you, that gives you enough time to read and plot and decide what you want to do. Like I said, there's hundreds of different indicators out there. Same for oscillators. I say try not to use no more than maybe 3 to 5. I think 8 will probably be pushing it. Um, but I think like 5 is a sweet spot, or maybe 4 to 6, whatever you might want to do. But it's up to you, whatever is easier for you. So don't try to use too many, and again, don't rely on just one or two. Okay, have a mixture. Um, Technical analysis, of course, two guys understand it's not the complete answer to trading. And it's not like you're going to learn this and become an expert trader and start making hundreds of thousands of dollars, easily, okay? Um, of course, some people might say it's all BS. You're just gambling. I personally say it's risk management. Life is a gamble. Starting a business is a gamble. So I don't find it as a gamble. When you have a plan and a strategy, you're not gambling. Okay, you're managing your risk. My opinion, and textbook definition as well too. But that's pretty much how that goes. Um, Again, technical analysis combined with like the right trading strategy for your personality, the right psychological and emotional discipline, the right risk management, and along with experience in the market is what makes you a good trader, guys. This is the reason why you see so many people fail and all these gurus try to tell you they could teach you this secret and I have this strategy and I do this and it 100% works. Don't let them fool you. No strategy fits all, okay? And you have to find a strategy that works for you. Even if they think they have the magic strategy, the market will figure it out and make it not work. Trust me. Um, so you want to be ever evolving as a trader, especially if you're dealing with technical analysis and trading on a daily basis. Okay. Um, and of course, that depends on what type of trader you are. You're a swing trader, probably not as much. But yeah. So kind of understand that. Don't let no one have you thinking that one strategy is the best. There's a lot of things that go into becoming a good trader, and mainly screen time. No one is going to teach you time. They can't teach you time. You have to actually be in the market to do that, okay? And don't get caught up in like the sunk cost fallacy. If you don't know what that means, and I talk about this in the psychological video that I'm doing for you guys in the course, but the sunk cost fallacy is basically, where we're making decisions that are irrational and lead to like, sub suboptimal outcomes kind of thing. You're focused on your past investments instead of the present and the future. Benefits, you kind of commit yourself to a decision you can't really fix anymore, and it's not really in your interest. So don't get caught up on, oh, I wish I would have done that. I wish I would have done that. No, that's a sunk cost fallacy. Don't worry about that. Um, it's not going to affect you going forward. Okay. So yeah. So keep that in mind, guys. That's just my tips and tricks on thought on trade technical analysis. Again, I know it's a lot. If you sat through this video, congratulations, because it is a lot of information to sit through and learn. And I applaud you for doing that, especially if you did it all in one setting. I know I couldn't. You see, I had to take breaks just to even teach it to you. Still kind of mad I missed out on, that money with Snapchat. But again, I'm doing it because I love you guys. I had time on my hand, but congrats to all of you that was banking in the chat room and stuff like that. And guys, if you did like this video, because it took me a while to put this together, three, I wanted to make it everything so you don't have to go from place to place to try to find this information. Definitely give me a thumbs up, thumbs down, comment, like, and subscribe to the channel. I'm gonna have more stuff coming out for you guys, and it helps me feel good and motivated for doing this. So definitely would appreciate if you could do that. But I'll end it up here. Hope you guys learned a lot. And if you guys traveling to any places, let me know so I can get some tips on where I need to go next. All right. Until then, guys, y'all stay green. All right, guys, that's pretty much it. You're now well versed when it comes to doing technical analysis and being able to read charts. So if you guys like this content and want more like this from me, do me a favor, hit that like button, comment below, and subscribe to the channel. I'll be putting out more videos like this to give you more information about various things in the financial market, so that way you can learn a little bit more and be able to gain. Stay green.